Let's talk about one of the biggest money mistakes people make. And honestly, most don't even know they're making it. We're going to break down saving versus investing and really get into why understanding this difference is the key to actually building wealth. Okay, let's jump right in.
So I want to start with a really simple question. Imagine you're super disciplined. You put away 10,000 rupees every single month for 20 years. No breaks, just consistent saving. At the end of all that, how much money do you think you'd have?
You'd be sitting on 24 lakh rupees. The math is pretty straightforward, right? 10,000 a month for 240 months, and hey, that's a solid chunk of change. 24 lakh in the bank. I mean, that sounds pretty good, doesn't it? It feels responsible. It feels safe. But is it really the smart move? Well, here's the kicker. If inflation is chugging along at an average of, say, 6% a year, which is pretty typical, the actual buying power of your 24 lakh gets sliced in half. Yeah, the number's the same, but what you can actually do with it, what it can buy you, has been drastically reduced. See, saving alone doesn't build wealth. It just slows down how fast you lose it. So let's really define our terms here. What is the actual difference between saving and investing? And what is your money doing when it's just sitting there? I mean, we've all heard this a million times, right? From our parents, our grandparents. You have to save your money. Stop spending so much. Just put in a safe FD. It's the financial advice we all grew up with. And what they're really talking about is saving. Saving is all about one thing: safety. You're putting your money in a savings account, a fixed deposit, maybe even under the mattress. The main goal isn't to make more money. It's what we call capital protection, just making sure that the amount you put in doesn't shrink. But this brings us back to that hidden problem: inflation. The best way to think about it is as an invisible tax. It just silently eats away at the value of your cash year after year. You never get a bill for it, but trust me, you're paying it. Your money is losing its punch, even while it's sitting safe in the bank. Now, let's flip the script and talk about investing. Investing is totally different. It's not about storing your money. It's about putting your money to work. You're deploying it, sending it out into things like stocks, mutual funds, or real estate with one clear goal in mind: growth. This little table lays it all out perfectly. With saving, your goal is protection, so the trade-off is low risk for a low return. With investing, your goal is growth, which means you have to be comfortable with higher risk to get the potential for much, much higher returns. It's that classic risk-reward balance. All right, now we get to the part that changes everything. This is the reason investing can create fortunes while saving can't. Let's talk about the power of compounding. This, my friends, is where the magic happens.
Okay, let's go back to our original scenario. Saving 10,000 rupees a month for 20 years got you 24 lakh rupees. But what if you had invested that same 10,000 a month and earned a pretty standard 12% return? Well, look at the chart. You wouldn't have 24 lakh. You'd have nearly 99 lakh rupees, almost a crore. The difference is it's staggering.
And that, right there, is compounding. It's so simple, but so powerful. It's your money making money, and then the money it just made starts making its own money. It's like a snowball rolling downhill, getting bigger and faster all on its own. It is, without a doubt, the most powerful force in finance. So investing is the way to go, right? Well, hold on. It's not that simple. You can't just blindly throw your money into the stock market and hope for the best. You need a system. Strategy is what separates building wealth from just, getting lucky. And let's be really clear about this. If you're investing without a plan, without any understanding of what you're doing, you're not actually investing. You're gambling. And that is a very, very fast way to lose your hard-earned cash. So here's a really smart framework for thinking about your money. Break it down into these 3 layers. Layer 1 is your survival layer. This is your emergency fund, maybe 6 months of living expenses, sitting in a totally safe, easy-to-access account. Layer 2 is for stability, money in things like low-risk funds. And then there's Layer 3. This is your growth engine. This is where your equity, your mutual funds, and other long-term assets live. Now, here's the crucial insight. Most people spend their entire financial lives stuck in Layer 1. They're just focused on surviving, on saving. But real, life-changing wealth, that is almost exclusively built up there in Layer 3. You absolutely need the first 2 layers as your foundation, but then you have to have the courage to start building the third. Knowing what you should do is only half the battle. It is just as important to know what not to do. So let's go over the biggest mistakes that completely derail people on their journey to building wealth.
Here are the big ones. Waiting too long to start. That's probably the costliest mistake of all. Then there's trying to time the market, that impossible game of trying to buy at the absolute bottom and sell at the absolute top. Big mistake. Panic selling when the market dips is another classic. You're just locking in your losses. Not diversifying is putting all your eggs in one basket. And finally, confusing short-term trading with long-term investing. They are two totally different sports. You have to burn this into your brain. Building wealth is a marathon, not a sprint. The get-rich-quick stories are usually just that, stories. In the real world, it's slow, it's steady, and sometimes, it's a little boring. Patience is your real superpower here.
So, what is the single most valuable asset you have in your wealth-building toolkit? I guarantee you it's probably not what you think. It's not some secret stock tip. It's not a big pile of cash to start with. Just look at this. Someone starts investing that same $10,000 a month at age 25. By age 45, they have almost a crore. Now look at someone who starts just 10 years later, at age 35. Same plan, same money. By 45, they only have 23 lakh. That 10-year delay cost them over 75 lakh rupees. It's unbelievable. And that right there brings us to the single most important lesson of this entire explainer. When it comes to investing, the amount of time your money has to grow is so much more powerful than the amount of money you start with. Starting early with a little beats starting late with a lot, almost every single time. Your most valuable asset is time.
So let's end on this thought. Saving is about protection. Investing is about growth. You need both. But if you only save, you're just treading water. If you invest smartly, you can actually build something. Money isn't meant to just sit in an account, slowly losing its value. It's meant to move, to work for you, and to grow. And now you know how.